uncovering the Greensill Capital scandal, trust, loans, and betrayal. Imagine lending money to a business not because you're buying its products, but because you're betting on the trust between that business and its suppliers, and then discovering that trust was a house of cards. That's exactly what happened with Greensill Capital, a financial startup that promised to revolutionize supply chain finance, only to collapse spectacularly in 2021. Its fallout didn't just rattle small suppliers, but sent shockwaves through global banking giant Credit Suisse, sparked debates about financial regulation, and exposed how complex financial engineering can obscure real economic risks. To understand why Greensill's collapse mattered and why it hit Credit Suisse so hard, we first need to break down precisely what supply chain finance is, how Greensill's model was different, and what went wrong. At its core, supply chain finance is a way for businesses to improve their cash flow by getting paid faster. Imagine a manufacturer that orders raw materials from multiple suppliers, but typically pays them at net 60 or net 90 days, meaning payment arrives 60 or 90 days after delivery. The suppliers, meanwhile, prefer quicker payment to manage their own working capital. Traditional supply chain finance arrangements solve this by allowing suppliers to sell their invoices to a financial institution, which pays them immediately, but at a small discount. That institution then collects payment from the buyer at the original invoice date. This creates a win-win. Suppliers get cash sooner, buyers extend their payment terms, and financial institutions earn fees or interest. Globally, trade and supply chain finance is estimated to support trillions of dollars annually in commerce. According to the International Chamber of Commerce, it facilitates around $10 to $15 trillion a year. But Greensill Capital took this centuries-old financial service and turbocharged it, or so it claimed. Founded in 2011 by Lex Greensill, a former Morgan Stanley banker, the firm quickly grew to become the dominant player in supply chain finance, reaching a valuation of nearly $10 billion by early 2021. Greensill attracted major corporate clients like the steel giant GFG Alliance, the UK's Virgin Group, and fast-growing tech companies such as SoftBank Vision Fund-backed firms. What set Greensill apart was its heavy reliance on technology and aggressive funding strategies that blurred the lines between traditional supply chain finance and more opaque financing. The company built tech platforms that claimed to digitize and analyze the entire supply chain, offering faster and more tailored financing. More importantly, Greensill innovated by packaging these loans into asset-backed securities, selling bundles of receivables to investors in capital markets. This offloaded risk from Greensill's balance sheet to others, allowing it to originate far more loans. This model initially drew enthusiasm from investors hungry for yield in a low-interest rate world. Investment funds managed by Credit Suisse became major buyers of Greensill's supply chain finance securities. Between 2018 and 2020, Credit Suisse's supply chain finance funds gathered approximately $10 billion from institutional investors, promising steady returns with short durations and low default risk. However, underneath the promise of smooth cash flow and digital innovation, Greensill's model harbored vulnerabilities that few outside the company fully understood. A crucial weakness was client concentration and the quality of the underlying receivables. While supply chain finance arrangements usually involve a diverse mix of suppliers and buyers, Greensill's biggest client became GFG Alliance, a privately controlled group focused on steel and related industries. GFG's complex financial arrangements required billions in financing to keep operations running. To give a sense of scale, in 2020, more than $6 billion of Greensill's outstanding receivables were linked to GFG companies. This concentration dramatically increased risk, especially since some of GFG's loans were backed by assets rather than standard trade invoices. Greensill's aggressive underwriting standards and reliance on limited assurance audits further obscured the real credit risk. Meanwhile, Credit Suisse's funds seeking steady yield funneled billions to Greensill. By late 2020, the $10 billion in funds for supply chain finance made up a significant exposure for Credit Suisse. The bank touted these as low-risk, short-term investments, but the reality would prove far more complicated. The first cracks began appearing in early 2021. In March, Greensill Capital filed for insolvency after its main insurer, Tokio Marine, refused to renew a $140 million insurance policy that covered some of its asset-backed financing. The policy was a crucial backstop that enabled Greensill to package and sell loans. Losing it dramatically restricted Greensill's ability to fund operations. What caused Tokio Marine's withdrawal? Investigations revealed irregularities in Greensill's documentation and concerns over the true nature of some receivables. For example, Greensill had extended financing on invoices that appeared fabricated or had dubious origins, as uncovered by a Reuters investigation in March 2021. These concerns raised doubts about whether Greensill's asset packages truly represented real economic activity. As word spread, client confidence evaporated. GFG Alliance faced cash flow issues, and Credit Suisse froze redemptions in its $10 billion supply chain finance funds to protect investors. The bank eventually shut down the funds in March 2021, sparking multiple lawsuits from investors demanding their money back. Credit Suisse's reputation suffered as much as its balance sheet. The firm was revealed to have little direct oversight over Greensill's lending quality or risk controls. A subsequent internal review found that senior Credit Suisse staff had overlooked warning signs about client concentration and valuation methods. The crisis also spotlighted gaps in financial regulation. Greensill operated under relatively light-touch supervision compared to banks, yet its activities had systemic consequences. The UK's Financial Conduct Authority and Germany's BaFin both launched probes into Greensill's practices and the marketing of related financial products. For small suppliers around the world, the collapse was devastating. Many had relied on Greensill financing to access working capital, but were suddenly left in limbo, uncertain when or if they'd receive payments. This illustrates a deeper problem: the shadowy expansion of financial products into real sectors of the economy, which can amplify risks rather than mitigate them. The fallout extended well beyond Greensill and Credit Suisse. The incident intensified scrutiny of supply chain finance as an asset class, with concerns that regulatory frameworks and risk management practices lag behind rapid fintech innovations. Credit Suisse itself embarked on a major overhaul, ultimately writing down more than $4.7 billion related to Greensill exposure. To put the scale in perspective, Greensill's insolvency in March 2021 was one of the largest failures in the relatively obscure niche of supply chain finance, and Credit Suisse's losses were a significant hit in a year already plagued by challenges, including the Greensill Capital collapse. So why did Greensill's model fail so spectacularly? The story underlines the dangers of financial engineering that depends on complex layers of third-party risk, opaque asset quality, and concentrated borrower exposure. Greensill's aggressive growth strategy outpaced the risk controls and due diligence necessary to ensure that its loans were backed by real, verifiable trade activity. Moreover, Credit Suisse's enthusiasm for yield in a low-rate environment may have blinded it to the mounting risks. The bank's failure to enforce strict oversight contributed to the extended duration of exposure to Greensill's troubled assets. In a broader macroeconomic context, the Greensill scandal reflects growing tensions in global finance between innovation and regulation. As fintech firms and non-bank lenders develop new models to fill gaps in traditional banking, regulators face challenges in adapting rules to ensure these activities do not sow systemic risk. Supply chain finance itself remains a vital part of global commerce, supporting massive volumes of trade worldwide. According to data from the Asian Development Bank, global trade finance gaps, where demand outstrips supply, averaged around $1.5 trillion annually, especially affecting small and medium-sized enterprises. The Greensill episode also highlights how financial crises don't only happen in headline-grabbing areas like derivatives or retail banking, but can emerge in less visible corners like supply chain finance. The complexity and sometimes novelty of these financial products can obscure the risks until a major shock reveals them. In response, banks, investors, and regulators have taken steps to reassess the risks inherent in supply chain finance. For example, the Basel Committee on Banking Supervision released enhanced guidelines on the treatment of trade finance exposures, emphasizing transparency and risk sensitivity. Meanwhile, Credit Suisse's stock price and credibility took a hit throughout 2021, reflecting investor concerns about its risk management. Its CEO stepped down amid the turmoil, signaling the gravity of the incident. Looking ahead, the Greensill collapse stands as a revealing case study in how innovative finance can spiral out of control without proper oversight, robust risk assessment, and transparency. It underscores that even well-established financial services like supply chain finance require diligent management of concentration risk, asset quality, and customer vetting. At the same time, the scandal calls attention to the global need for improved trade finance access, especially for smaller firms. Filling the $1.5 trillion trade finance gap sustainably, without repeating the mistakes of Greensill, will require balancing innovation with caution, ensuring that lending truly reflects real economic activity rather than paper promises. The mechanics here were almost laughably simple. Package invoices, securitize them, sell to investors, and grow the business quickly. But that simplicity masked a complex web of risk that caught multiple parties unprepared. The Greensill story reminds us that in finance, opacity and overconcentration are often a recipe for disaster, no matter how glossy the technology or strong the institutional backing. In the end, the Greensill saga is a cautionary tale about what happens when rapid financial innovation outpaces governance and regulation. It reveals the sometimes fragile underpinnings of global credit systems and the profound consequences when trust, on which the entire supply chain finance model depends, breaks down. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Voyager Digital, the crypto lender that promised safety, then went bankrupt. You will not want to miss it. I will see you there.